Hello and welcome back to Dukascopy TV and to the first trading day of the week, which is why I'm bringing you the week ahead. A brief look ahead at what key events might be moving and shaking the markets over the coming days. Well, joining me on the line is Geoff Kendrick, the head of European FX strategy at Nomura, to discuss all this with me. Thanks for joining me, Mr. Kendrick, today. Let's start with Japan, as we've got data, a rate decision and a speech all happening this week. We've seen some very aggressive QE so far. What's next?
We shouldn't get too much out of the Bank of Japan. We're only 6 weeks or so beyond the historic April 4 meeting and announcement, which, as you're suggesting, is huge QE. More than double what the Fed have done in terms of percent of GDP. And so that is effectively the Bank of Japan have gone all in the short term by making that announcement a month or so ago. The main market concern is now around JGBs. So JGB yields have been fairly erratic since that April 4 meeting, and JGBs have been relatively soft over the last few weeks specifically, as we've seen money start to come out of the bond market and go into the Nikkei locally, and also partly cash starting to leak overseas, which is one of the things the Bank of Japan is looking for, and therefore a weaker currency. So long as JGB yields can settle now around that 0.8%, 0.9%, then it makes sense that JGBs have sold off because we are starting to price in higher expectations for inflation. But the Bank of Japan wouldn't want to see that get out of control because there would be potential mark-to-market losses for market makers in Japan and other.
Okay, let's head over to the UK. Now, last week saw a better inflation report from the BOE. We've seen signs today that the housing market is potentially recovering, and we've got a host of other data out this week. Is the UK slowly going from negative back to positive?
The data are improving very gradually in the UK, as you're suggesting. We kick off with CPI on Tuesday. We also have the Bank of England minutes on Wednesday and retail sales and GDP revision on Thursday. There's been some chat around the revisions on GDP, so perhaps some of the previous negatives could be revised out, which would be a positive surprise there. Bigger picture, though, the market is now really waiting for new Governor Carney to start in July. There was some chat over the weekend that he's already been in contact with the MPC members who will be remaining in place after July, and there's a potential talk about him obviously becoming more dovish when he takes over. So for now the data are improving, but we also are going to have a slightly different Bank of England from the July meeting, and specifically the August meeting when we get the next inflation report should be key. So ahead of those two, I doubt the market will be buying sterling or buying UK on the back of even slightly better numbers, because, as I say, we're expecting Carney to be a bit more dovish.
Now, all eyes are once again on Ben Bernanke this week, and we've got a variety of economy indicators on their way as well. Any thoughts ahead of Bernanke's speech on Wednesday?
The market has been buying the dollar in the last couple of weeks on the back of the view that eventually the US economy will be the strongest within the majors, and therefore the Fed will be the first to exit extreme policy measures. And so there's been a lot of chat around when and if that will come. And now that we've got Bernanke speaking on Wednesday, we'll get a lot more information on that from him. No doubt there'll be quite a few questions in that direction. We also have the Fed minutes the same day, 4 hours later. So we'll get a lot more info on what the Fed are thinking, as opposed to what the market is thinking the Fed is thinking. And so potentially, assuming Bernanke remains relatively dovish as he has done for the 6 or 7 years that he's been at the top of the Fed, perhaps this dollar buying spree could come to an end and we start to go more sideways in most dollar crosses after that key Bernanke speech on Wednesday. On the data front, it's slightly less exciting this week. The market is always fairly interested in jobless claims after last week's number was a bit softer there. And durable goods on Friday is probably also relatively key. But now, until we get the ISM payrolls week in a couple of weeks from now, the data is probably slightly second tier compared to Bernanke's speech on Wednesday.
Finally, the German IFO is due out on Friday. There have been nervous speculations about the state of Germany's economy recently. Should people be taking notice, or is it just a ruse?
Well, the key going into the next ECB meeting is whether or not they'll lower the deposit rate. But how the data plays out this week, and obviously ahead of that meeting, could potentially determine whether or not there's another refi rate cut at some point. The economy has been obviously relatively soft in Q1 particularly, the data that we got last week, we saw that Germany and specifically, and the Eurozone more generally, were quite soft. So the IFO is fairly key this week in terms of gauging market sentiment, as I say, going into that ex-ECB meeting. Really, the big picture is the US economy is stronger than Europe, and so we're kind of talking about second derivatives here. If you could get a slightly more dovish Bernanke and a slightly better IFO on Friday, perhaps euro-dollar could end the week higher than where it began.
Okay, thanks for joining me today, Mr. Kendrick. That's all from the week ahead. Plenty to look forward to. I'll be back tomorrow with the press review. Until then, goodbye.